We have a really nice crowd on today. Thanks for taking the time during the lunch hour to get together with us and learn a little bit about Trius Lending Partners and about investing with Trius Lending Partners. Um, I'm Josh Shine. I'm the CEO of Trius Lending Partners. Myself, along with our head of investor relations, Jessica Franta, are going to do a fairly quick walkthrough about our company, Trius Lending Partners, what we do, who we are, opportunities to invest with us, our track record, and how it works. And then we'll open up for questions and answers. We hope to present for about 20, 25, maybe 30 minutes maximum. And then after that, you're free to either go about your day, but we certainly stay on for questions and answers and encourage questions and answers. That's really where we think the meat and potatoes and the details really can come out. You can learn a lot asking anything at all about what we do, who we are, and how to earn money with us with a phenomenal long-term track record. A few housekeeping items. If you have questions, there is on the bottom, there's the chat button on Zoom and there's the Q&A button. Please use the Q&A button for questions. That way it's easier for us to track them and make sure we get every question answered. If it's possible, if it's an easy, basic answer, myself or Jessica may answer it while we're presenting. Just maybe type in the answers on the side, or we'll wait until after when we get to the Q&A session and we will get through, I promise, every single question and give you every answer to everyone. We've had webinars where we've gone and stayed for another 45 minutes afterwards, which we have no problem doing, or as long as we need to make sure every question's answered to everyone's satisfaction. That's what we're all about here, is providing you with the information and everything you need to make sure that you understand what we're doing. There's no bad question, there's no stupid questions, so don't be shy. The chat button, if you want to chat and either share your information or say hi to other people that are on the webinar. Like I said, we have a really nice crowd today. So feel free to share your information there. We've definitely had some people over the years at different webinars who have, traded information or said hi or shared their contact info. So feel free to do that as well. All right, let's kick it off. So we're going to spend some time here for people who are new to Trius Lending, new to investing with Trius Lending, and to this kind of portfolio diversification. So what we're going to talk about is something that's obviously a lot different than traditional investing in stocks or bonds or your retirement account, as you're maybe used to reading about and understanding the traditional stuff out there. We're all about safe and consistent returns, and you'll hear about that through our presentation this morning. This isn't Bitcoin or Tesla or Nvidia. This isn't something that's got high flying returns. It has a very consistent and steady, incredibly safe return, and that's really what we're all about. We also have some people on here, and I see some names on the screen here who are existing investors with us. And so some of them like to learn more and like to get a refresher on what we're doing and what we're up to. And then, of course, we put this on here. If you really love webinars and have nothing to do on your lunch hour, this is the thing to do on a Wednesday. But hopefully that's not the case. You're here for much more important and exciting reasons. All right, let's jump into it. So Trius Lending Partners is a private money lender. Okay, so what that is we exist for people who need quick and easy access to funding for real estate projects. This is not your own home or a vacation home for yourself. So we don't do owner occupied or what's called a primary residence type of loan. So we don't do someone's own home that you're going to live in. We only do investment properties and commercial properties. So what does that mean? That means a fix and flip, a buy and hold, all the TV shows you might see with people who buy properties and renovate them to hold them as a rental, or buy properties and renovate them and flip them as a sale and make money on it. And then we do a lot of commercial transactions. It might be a warehouse, it might be a retail strip center, it might be a manufacturing facility. We don't really do offices per se. That's not really so popular these days. But we've done some company headquarters. We've done mixed use, which could mean maybe a bar or restaurant or a retail. We've done some hair and nail salons, that kind of thing. So different types of commercial properties. And so what we exist is for someone who doesn't have the time or patience to go to the bank. It doesn't mean they're not approvable by the bank, but they don't want to take the time and effort to go through the bank because the bank takes a lot of time, paperwork. If you've been through an agony of trying to get approved for a loan, and time is money in the real estate game. And so what we offer and the kind of lending that we do is quick and easy access to funds. So someone can call us up, today's Wednesday, and say, hey, I'm closing on a loan and it's not going to close on time with the bank, or I just need to close very quickly. I want to get this place renovated and get it on the market. And I don't want to spend 45 or 60 or 90 days working with a bank. I want to close quickly. Today's Wednesday. We could conceivably collect information from someone today, have them approved by Friday, and close by early next week. So that's a really quick timeline, and that's really key for being able to put your money to work and get your real estate project off the ground quickly. So that's how we put the money to work that we will talk about, that we raise and invest with people. We work along the entire East Coast. Our core area is the Mid-Atlantic, right? So Maryland, DC, Virginia, southeastern Pennsylvania, Virginia. That's really the core of where we do our business. But as we continue to expand the business, we're continuing to head down the East Coast. So we're doing some more business on a case by case basis through the Carolinas, Tennessee, Georgia, and into Florida. Um, but we love the Mid Atlantic a lot. And we love the rest of those areas as we continue to expand in them. We like to make sure we're very safe and understand the markets we jump into. We don't quickly jump into unknown markets. We don't quickly jump into neighborhoods, areas, cities, or towns that we don't have the comfort level in. We're all about safety and security and making sure we're only lending in areas and on properties that we feel a 100% confidence level on understanding that value and understanding that area. We don't want to take risks with anyone's money, with any of the loans that we do. Overall, which we'll get to on another screen, we have $115 million that we've raised from individual investors, like those of you who are on the call right now, on the Zoom right now with us. And we have taken that money and paying a healthy rate of return to you, the investor, and then lending that money out to real estate flippers, commercial investors, et cetera, who need quick access to the money. So the loans themselves generally range from 6 to 9 months on a loan, sometimes as long as 12, but a lot of them are generally 6 to 9 months. They're usually paid off by that time. So we're short-term funding to get that property acquired, renovated, and back on the market, either for a new loan or, as I said, for a sale, which would be a flip as well. Okay, next screen, please. So a little overview of us. So we were founded in 2003 by our esteemed chairman, Mr. Steve Bond. He started the company with himself and his money and a few friends' money that he was looking to put to work. People were contacting him and saying, look, I'm working with the bank. It's a super duper pain in the butt to work with the bank. Would you be willing to lend me some money for a property I'm buying, a property I'm looking to renovate, a property I'm looking to redo the kitchen, redo the floors and the paint, and then put it on the market and sell it? And he said, sure, sounds good. Long story short, 20 years, 20, whatever, 20, 22 years later, we have a phenomenal track record of having provided those loans for real estate investors for 22 years and a consistent, steady return with no losses for our investors in those same 22 years. And that's really key for our track record, that we've had losses over that time, but we've absorbed those losses ourselves and we don't pass those losses along to our investors. So everyone's principal has been preserved. And that's what's unique about this type of investment. When you invest in a traditional stock, your stock might go down. You could lose money on it. It may or may not. With us, that principal amount that you invest, and we'll get into some of those details in a few more slides, it doesn't go down. It stays where it is and pays a consistent return on an annual basis. And that's really the key with what we do. And that's the key to it being really safe. As the company's built up, I came on board. Steve's son David came on board. The rest of the team, Jessica, Steve, Celeste, as we've continued to build the team out over the years, we've had that impeccable track record, and we've had a significant growth rate. We've grown at about a 20 to 30% rate on an annual basis. You can see in that chart there, as our assets continue to build up over time, as we've continued to lend more money and keep that great track record. We've been awarded with some really exciting, we've been on the Inc. 5000 list 3 years in a row. We won the Better Business Bureau Torch Award for ethics and being straight shooters and being open and ethical in every aspect of what we do is so important to who we are and so important to our business model. These great relationships with our investors, great relationships with our clients and customers. So that resulted in us winning an award with the Better Business Bureau. And we have a lot of great reviews. So if you have time when you're done listening to this, check us out on Google, look up Trius Lending Partners, read the reviews. You'll get a really great example of the experiences people have with us, experience in working with us, and the great customer service, hand-holding, and very upfront, ethical and straightforward, straight talking approach to how we do business with everyone on a day-to-day basis. And I think that really tells the story in a really nice way. So if you have time, I would encourage you to do that. At the end of the day, we work with our experience, our expertise to do that single family, multifamily, and small commercial properties. That's how we run our business. All right. Jess, why don't you take this slide and run through some of our foundations of success?
Yeah, absolutely. Real quick, the sun is actually shining out where I'm at, which is awesome. So I apologize
Congrats.
if it goes in and out of my eyes, but thank you all again for also attending. Your time is super valuable. So we are grateful to be here and grateful that you're here. As Josh mentioned, I head up investor relations for Trius Lending Partners. So really, once you become invested with us, I am the primary focal point of contact and support you throughout kind of your investment journey with us. But that being said, actually, the cool part is that I came by the way of being a borrower. So my story with Trius started a number of years ago. My husband and I had been growing our own rental portfolio. We'd kind of outstripped our own funds, and we were searching for a private lender, found Trius Lending Partners and never left. So over the course of about 4 years, we did 10 deals, and just kept coming back because of just outstanding customer service, reliability, and all the things that we're going to kind of these foundations of success. So I really, really fundamentally believe in how we run our business and the value that brings to our borrowers, and then really how that translates to our investors as well. So, okay, so kind of to get into it, if you are a borrower, some of, how we operate. Trius, we have an in-house team of originators and managers. So when a borrower approaches Trius Lending Partners and we're looking to borrow money, that is all handled in-house. You work with a loan officer, sales officer, and then that particular deal is actually underwritten in-house. We specialize, we know our numbers, we know the area, and we will really be able to look at that deal without having to go into any external service providers, which really adds also a facet of speed. Real quickly, Josh had mentioned earlier in this presentation that that is something it differentiates. And if you're looking to do a good deal, if you are a borrower, being able to close in a quick, timely manner, that can make you more competitive. And that makes your offer more meaningful to a seller who's got a great deal. So again, this is very much a borrower's perspective, but it means to an investor. It's just the value and then also the deals that you as an investor are investing in and on. Um, we are not an equity-based lender. What does that even mean? Well, what it means is that we are looking at the property. We are underwriting the property in-house, as I just mentioned, but moreover, we are also looking at every single borrower. We check their background, we check their credit, we check their income. We are looking at the borrower's ability to, essentially pay for the loan, get out of the loan, pay us off. But also, we want the borrower to succeed. I think I forget we may not have gotten there yet, but about 45% of our borrowers are actually repeat borrowers. It's one of my favorite parts of the story of Trius Lending Partners. Obviously, I was one of them, but that just means that the borrowers are gaining experience, and that they're able to do the deal. And so, really, we're not just lending on that property itself; we're lending on the whole picture, the borrower and the property. Consistency and expertise. I think that's actually, it's funny when I talk to investors, I often say, hey, listen, we're not very exciting. We do the same thing, we do it over and over and over again. But actually, I think what is exciting about that is it makes us some of the best in the business. So we're incredibly consistent. Our underwriting is consistent. The same people are looking at everything, and it's made us really experts within our field, and most particularly within kind of the Eastern region, the East Coast as we've grown, but of course, most specifically the Mid-Atlantic. And then we keep and service all of our loans, so again, importantly, what we underwrite, what we lend on, we maintain responsibility for. And that also adds customer service to our borrower, but also really make sure that with our investors, if and when we're ever communicating about a specific property we lent on or a specific borrower we've worked with multiple times, we know the entire story. We're able to answer all the questions. We're servicing it currently. And I think that really brings value to who we are and what we do. We are, as Josh mentioned, very conservative. We're safe. And like I said, sometimes we're the least exciting part of your investment portfolio we may have. I actually now take pride in that. Like I just openly, to Josh's point, we're never going to be Bitcoin, and we're super okay with that. In fact, I think we take pride in it. And so, in terms of risk management, because of our conservative underwriting, because of a conservative placement in terms of loan to value, what we issue to our borrowers, what that looks like, we are very, very conservative in how we manage risk. And of course, that translates really well to investors and our performance with investors with the history of no losses. And then finally, equally as important as anything else on this slide, very much relationship based. I guess I did get a bit ahead of myself, but 45% of our borrowers come back. I think it's meaningful, it's impactful to the business, it provides longevity. And then also, what a really cool part of the story, and all the credit goes, of course, to Mr. Steve Bond, and then, everybody that has grown subsequent. But some of our same investors from day one are still with us. And so that is 22 years of returns year after year, month after month. We've been a part of so many families' retirement portfolios, family trusts in really meaningful manner. And we take pride in that. And we also take it very seriously. Those relationships matter. They're the foundation of everything we do and who we are.
All right, so let's jump into investing with us. Let's get down to the details here. So there's three main methods of investing with us. Direct note investing, and the Trius Lending Fund one is investing in these loans that we just talked about. The real estate fund is investing into rental properties. So I'm going to do a quick summary on the different methods, and then Jessica's going to jump in as well. I want to be clear when we talked about the customer service, and Jessica said the amount of people that have stayed with us, both on the customer side and the investor side, that's really a testament to our success. Those investors that have been with us for 20 plus years, our retention rate with our investors is like 99%. So investors come with us, they stay with us, they don't leave us. It's a really strong part of their portfolio. And I think that really tells the story in a big way. Direct note investing. Let's go to the next slide. I'm going to start it off. I'll let Jess pick it up from there. I was just with someone this morning. We were talking about the differences. Essentially, we've run into people who like to invest in our mortgages in two different ways, and we sort of offer both as options for whatever the comfort level is for different people. Different people look at risk differently. Now, we would say there's no risk with either because we've had the same incredible track record of no losses with either. I want to emphasize again, we've had losses ourselves. It does happen. Even though we're conservative, we have a personal guarantee on every borrower. We make sure to check, as Jessica said, the credit, the income, the assets, the background. But things still do go wrong, and we do have to take back properties or deal with foreclosures or whatever it might be. When that happens, we never pass along any expense, any pain and suffering, or any losses along to our investors. That doesn't matter which approach you take, the direct note approach or the fund approach. Some people like the direct note approach, which is simply attaching your investment to one specific note on one specific property. So say we did a loan for someone on 123 Main Street. That loan maybe is a $200,000 loan. And our minimum, by the way, is $100,000 for investing. So someone might say, I'm willing to invest in that. I'll give you the $200,000. I want to be on the direct note itself. We would take that person's investment. We would put them on the specific note itself. They would have that note assigned in their name. Some people like that. It's not great. You can't reinvest it, and it pays off quickly. And I'll let Jessica get into the details on that. So as we grew the business, we said, let's set up a fund as well, which is a pool of all of the mortgages, or a large portion of the mortgages, of first lien mortgages with the investors. And that is not a specific property it's tied to, but it's tied to a whole group of properties. The returns are very similar. There are some different benefits to one over the other. It really becomes a choice and a comfort level for people. So Jess, you want to run into the details on each one?
Yeah, absolutely. Thanks, Josh. So, as Josh mentioned, I think one of my personal favorite things, because obviously I get the opportunity to talk to investors all day, and it's such a simple saying, but I think it's pretty meaningful, which is personal finance is personal. What works for one person doesn't necessarily work for another, but both are great and both are successful. So we're super agnostic. As Josh has mentioned, there are some differences based off the same security, same consistent underwriting and everything. I think to start off real specifically, defining accredited versus non-accredited is important in the context of this conversation, because our direct note investing is open to both accredited and non-accredited. The difference is essentially an accredited investor simply defined. There's a lot of different definitions. The two most common are individual net worth of exceeding 1 million, excluding your primary residence, and or income in excess of 200K. If you're filing individually, 300K, filing jointly married. Honestly, if you have questions about this, we won't delve into it. You reach out to me, and all my information's at the end of this presentation. Super happy to go over and answer questions on that. We won't spend much longer. Just know that there are some kind of, checks and balances we have to make sure you qualify for if you invest in the fund. But direct note investing is open to everybody. We also have a lot of folks that start investing with us and do direct note just to kind of feel it out, and then gain a level of comfort for who we are, how we operate, what we have to provide. And then honestly, then they go over and they end up investing in the fund. So as Josh mentioned a lot of the highlights, but direct note investments, typically the average period is 6 to 9 months. You're working with myself or one of the team members on investor relations, and we really tailor it to meet your needs. I kind of joking oftenly say, like, it's sort of like you're dating kind of that particular loan. What is your personal preference? Is it area? Is it, a borrower profile, maybe a really experienced borrower, Dane or Jessica Franta, like we were, where we had 9 deals under a belt, and that made you feel comfortable as an investor. So it's a one-on-one conversation, which is fantastic. It's an opportunity, again, to answer questions about our business and to really make sure you feel good about what you're investing in. It is open. I think this is really cool, to self-directed IRAs. We are seeing a lot of our investors start to utilize their IRAs in a self-directed. And again, I help guide that process. I won't get into the details of it, but we're really experienced in that. And we are able to help if you want to look into using your IRA funds towards real estate. That's something we can facilitate, as well as also 401k rollover. Similarly, investment to the fund can also do self-directed IRAs. Again, we would just assist with that. The fund is a 1 year commitment. So typically a little bit longer of an initial commitment, where notes for 6 to 9 months and then get paid off. I apologize. I'm getting chased by the sun, which is great. I'm super grateful to see the sunshine. But as I go to the side of the screen, I apologize, everybody. One really cool aspect to the fund is the ability to reinvest. So each month, we pay interest monthly. It's annualized, but paid monthly. And on notes, it pays out. So at the end of the year, you get a 1099 interest income form. For the fund, you get a K1. Again, won't get into the details, but the difference is that our investors have the opportunity to elect to just simply reinvest their interest. A huge percentage of our investors do that. And the beauty of it, of course, is compounding interest. I forget, they call it, like, what, the eighth wonder of the world. But it really, really can help you grow your assets and everything like that, and kind of juice your return, increase your return, as it were. Open to accredited investors. And then, as I mentioned, you get a K1. One last factor to the fund that I think makes it really fantastic for investors is that, and again, we can get into the details if you're interested. I won't do it now. It has what's called a sub REIT. And that really allows us to do, again, that gets detailed, a QBI, qualified business income deduction, which enhances our returns through a bunch of kind of, it's taxes. It's how we are able to apply taxes and, essentially, again, I don't want to get too far into it. I geek out. As a side note, I have a tendency to get into the details, so I'm trying not to do that today. But we really are able to enhance your return through tax advantages. And we've got kind of samples of what that looks like, but it boosts your return as the investor. And that is something also a lot of our earning and income investors are seeking, our tax advantage investment strategies, and the fund is able to provide that benefit to our investors. I think we'll go to the next slide.
Yeah, so I'll start off here, and then Jess can take over. So the rental fund. So as we grew the business and have had those other two approaches, which is the note investing and the fund investing, a lot of our investors said to us, "Why don't you guys get into doing rentals themselves?" Right? You're in that business all the time, so you know the business, you know the marketplace of long-term holding of real estate. So we said, you know what? Let's do it. It does make sense. We do see and have access to properties, deals, and opportunities. We understand the market. We obviously, if we fund those loans, we know what works, we know what doesn't work, we know what's profitable, we know what's not. So we really feel like we have a high confidence level and incredible experience in investing in real estate overall. We'd never done it before, but we said, you know what? It does make sense to do it. So this is a lot different than we talked about in the previous slide and the traditional note investing, which is that safe, conservative, steady return. This is the higher return. This is the more aggressive return because it's investing in real estate. It's a longer term fund, so it's a longer commitment. So it's a 5 to 7 year commitment. It's got a much higher upside return because it's investing in real estate over the long term. So we're not trying to recreate the wheel. We're not trying to do anything different or unique than what other people do. We just know that our expertise, our knowledge, our brain capacity, and our access to deals, opportunities, and marketplace is better than other people out there. And so what we're going to do is simply raise money, buy a lot of rental properties, single family rental properties throughout the greater mid Atlantic and down south as well. Hold those properties. The rents go up over time. The property values go up over time. The mortgage balances pay down over time. And that's how anyone makes money in real estate doing the long term hold plan. And so we're just trying to simply take that business model instead of you having to say, I don't want to rent, own properties and have to get the call in the middle of the night, have to unclog the drain or deal with a leak coming through. We deal with all that. You still get the benefit of owning real estate. So everyone in this fund would own a piece of a large portfolio of real estate properties and be able to benefit from the tax depreciation on the front end and from the overall benefit, growth, and appreciation over the long term. We believe, based on our modeling, it's a high double-digit return in the teens, and we believe that's going to be very doable. Everyone's really enthusiastic about the real estate market and the rental market, particularly in the greater mid-Atlantic area. So we're very excited about this new opportunity to invest, and we're getting a lot of traction, a lot of enthusiasm with it. And we think there's a lot of deals out there. In the last week, we looked at a 30-unit portfolio in Baltimore County. We looked at a 60-unit portfolio in Philadelphia. So we're looking at different portfolios that are, again, deals that aren't on the market, not deals that banks or larger companies would see. They're deals that come to us because we know the people and are sort of in this marketplace on a regular basis. Jess, anything to add to this?
I really think you cover most of it. Similar to the fact that we've absolutely maintained great relationships with both our investors and our borrowers. We do that throughout the kind of the greater real estate community. So, we have a lot of connections, to Josh's point, that allow us to see off-market deals, an opportunity that maybe isn't, quite frankly, available to, for example, me as an individual investor. And then, of course, have the ability to then execute upon that. I think a great part of the story for the Mid-Atlantic market is that, if you were to say, there's been a lot of excitement about a lot of different markets, Austin, parts of Florida, Nashville. We haven't seen that run up. And then in addition, we don't necessarily even have the land mass to bring a lot of new units into play. So the combination of these factors just really makes the greater Mid-Atlantic strong, steady, and predictable, with the room for continued appreciation. And it's of course what we do and who we are and what we know best. So we can underwrite it incredibly well, and we're able to leverage all of our expertise. Again, I personally believe in it. I'm invested personally throughout the Mid-Atlantic, and so just really exciting and a great hedge against maybe some outside inflationary pressures and other things going on in different kind of investment markets and opportunities. Yeah.
Well said. Well said. So next slide, please. So here, we'll get into questions now, but I just want to sort of summarize. And again, as I said before, Jessica and I both feel the questions are really where the meat and potatoes are. Please ask away. Please type anything in here. Any question. Again, no bad question, no wrong question, no stupid question. Happy to answer them all. The steps from here are, and this is intended to be just a basic sort of overview on us as a company and on the investment opportunities with us. The next step, if you are interested, and we hope you are, is just a deeper dive, a deeper information session. That can be 5 minutes, 10 minutes, or 2 hours, whatever you need. And it would be you connecting with us, generally starting off with Jessica. I jump in, Steve Schless jumps in, our COO. Some other people might jump in as well to answer any questions. But It's sort of an offshoot conversation. It could be a phone call. It could be an in-person meeting in our office in Towson. It could be a Teams meeting, a Zoom meeting, whatever it might be, to really dig into the details on a one-on-one basis for what's a fit for you. How much money do you have? How much are you looking to invest? How does this work? Asking even more questions than we might cover right now during our Q&A. And to want to take that personalized approach and take the time on a personal basis to work with you one-on-one to answer your questions and make sure you're crystal clear on how this could work and how this could benefit your investment strategy for the future. So that's the key for the next step. We're going to get into some Q&A right now, but I would encourage you, and we'll share our contact information as well. And we have hopefully your contact information as well. Please reach out to us, any question, anytime about anything. And we're just happy to be a resource as well. We've been in the marketplace for a long time. As I said, we have a great reputation. We want to be helpful to new investors who are buying properties, new investors who are looking to invest with us to put money to work. Anything we can help on, we're always happy to be a resource. We have a lot of experience that have been doing this for a very, very long time. So let's jump into some of the questions. First question for direct note investing. Okay, so the question is will you be a first lien mortgage holder, and is there a website showing the list of properties and what's the average LTV? Okay, let me go through a few of the details. So on the direct note investing, the way it works is, first of all, everything we do is first lien mortgage only. We never do subordinate financing. We never do second liens or third liens or anything like that. We only do first lien mortgages, which is the safest and most conservative way to do any financing, to invest in any type of investment opportunity. So first lien mortgage is the only way to go. We keep the loan to value at between 65, sometimes 60, sometimes a little more than 65, but 65% loan to value is our average on what we do. So there's a lot of equity left over in the property. Again, a very safe, conservative approach to what we're doing. The states we're working in, some are mortgage, some are trust deeds. That's again on sort of an individual basis for how the structure would be. But the bottom line is that as investing in it, you would be presented. We don't have a generic website where we list the properties, but working with Jessica and her team, she's a few people on her team. You would say, "Hey, I'm looking for an investment of $200,000." We would say, "Hey, here's two or three different options for different notes and different properties that you might want that might be a fit for you in the $200,000 range." Now, again, all of our loans are good loans, so it's not a question of what's bad, what's not bad. They're all good loans. Some people are more attuned to saying, I only want someone who's done 10 deals, or I only want someone who does this neighborhood or this area. We try not to really be too specific on some of that stuff because it can get dangerous to get too picky on it. At the end of the day, we do good, safe loan to values, good, safe credit scores, personal guarantees, background checks on everyone, checking the income and checking the assets, and making sure they have skin in the game on all the deals. And so in that direct note investing, you'd be offered some opportunities, and then you could have that note assigned to you upon investing in that and get paid on a monthly basis from there. The other question is, do we do 24 or 36-month bridge loans? We generally do not. I can say I know there's one 24-month loan that's coming due soon. I don't believe we've done a 36-month that I can think of ever. So that's really not our model for what we do. Some of the larger deals sometimes go for 12 months. They might need a little longer than that as well. But really, the model for what we're doing is short-term investing, short-term loans. That's really the best way to do things there. So, Jess, you want to take the next one?
Yeah, the next question is, would we have K1 and QBI? That's a qualified business income deduction. That's what I was talking about with the Trius Fund 1. Benefits for the rental fund, so for the real estate fund. So you would receive the K1, correct. The QBI is not applicable to the real estate fund. But I would add, however, that there's a lot of benefits that go to the real estate fund that don't go to the Trius Fund 1, which is that, obviously with the real estate fund, we're able to recognize depreciation. Definitely we would be pursuing strategies of cost segregation, accelerated depreciation studies and recapture, and other things that will and that would benefit the investor. So that would enhance returns and you would actually feel those benefits, although the QBI in that particular case is not applicable. Josh, anything you want to add?
Yeah, no, that's literally what I would say is the tax
Okay.
benefits and the depreciation, and that's where you're going to
Yeah.
see major benefits on being a real estate investor. That's just how it works, and that's why people love investing in real estate. So You want to the next one?
So
Yeah.
yeah,
Yeah.
yeah. So is there a
Yeah.
balloon kicker, and how did we get to the 18% IRR where the return is 6? I am your team nerd. This Josh makes fun of me all the time. So the to your point, so a rental property on an individual level, even if then applied to 100 rental properties, it has a life cycle, right? So you obtain the asset, you stabilize the asset, whether it has a renter or not, you're stabilizing. And then, of course, as years go on and stabilization has occurred, you're able to start increasing rents. So that's your quarterly 6% return that's in this question. And you're like, hey, how do we get to a targeted IRR of 18%? That is absolutely the capital event at the end of that hold period. So Josh had mentioned a 5 to 7 year hold period. Well, it ends with the capital event, which is simply defined as typically, most commonly, the sale of the property, but could also be just kind of redisposition of it, even simply a refinance out and paying off the investors. So there is an aspect of appreciation, of course, in play prior to that capital event. And we modeled this pretty in depth and again on an individual level, I could get into it, but I do want to say this. While we modeled it, we actually, in very standard Trius form, used really conservative numbers. We were not predicting, and I see a question later which we'll answer. We are not predicting crazy amounts of appreciation in order to receive that 18% IRR. You've got to, of course, buy well. A lot of deals are made upon the purchase themselves, and I know we'll get into this a little bit in a second. So, but that's the beauty of Trius Lending Partners. We are experts in this market. We know what buying well looks like. We know what those numbers are to be positioned well. So it is both, a cradle to grave process, buying well at the very beginning, stabilizing, increasing rents, providing that quarterly cash flow, and then the capital event, where we actually get to recognize that benefit of appreciation in a pretty conservative, using forecasted conservative numbers. Josh,
And
again,
and yeah,
yeah.
and I would add, I mean, the question we've had from some people saying like, well, what happens if it doesn't work out in 5 or 6 years? What if you don't have that ability to have that windfall waterfall event to get that IRR? And to that, I say the standard line we use in real estate that we've used forever in real estate, it's not a matter of if, it's only a matter of when. So in other words, if we need to take a little more time, that could happen. So someone said to me, what if the market goes down? I said, if the market goes down, it extends another year or whatever it might have to extend to. But we all know one thing about real estate. Having lived through the 2007 meltdown and coming out the other side of that, there were some people during the 2007 mortgage and real estate meltdown who lost it all. And it was really tough times for a lot of people in real estate. For the people who were able to ride it out, for the people who had the patience and the pocketbook to be able to ride it out, they're looking right now, many years later, and they have 3, 4, and 5x the values of those properties, right? So time does heal all in real estate. Now, we're not going to be doing this fund for 25 years. It generally doesn't take that. Real estate's a cyclical industry. It sometimes has ups and downs that can range in a 3, 5, or 7 year time horizon. But we know that at the end of the day, no matter what, those returns are there and the rental market will be strong, continues to be strong because there's a housing shortage. That's a fact. And the bottom line is people always need a place to stay and a place to live. And I can't always say that about maybe electric cars or maybe microprocessors or chips or the new iPhone. I can't speak to any of those things and how required and essential those are to living. But a place for someone to live is always needed and necessary. And that's why we're big proponents and believers in that. My next question has to do with values and values in the mid-Atlantic and inflated values. And that's a valid point, right? So we're always keeping an eye on those sort of inflated values and figuring out how to buy right. I would say a few things with regards to buying right and making sure that we do our due diligence and use the access and network that we have. Number one, we are having to educate certain people who are trying to sell portfolios on the realities of the marketplace. So Jess and I and a few of us had a call yesterday about someone who's not realistic on what they think their portfolio is worth, and we're giving them the reality check on that. So sometimes it needs to be that kind of a conversation. And so we are having those conversations with people, but there are a lot of people who run into it. And we see this with our real estate investors, our borrowers who are borrowing money from us on a day-to-day basis. They'll say, I got access to a deal, an inside deal, an off-market deal, a friend relationship deal. Things happen and people need and want to move quickly and are willing to take a discount to make that happen. Sometimes it might be a financial issue. A lot of times it's family issues. I've run into many, many, many issues over the years where the matriarch, patriarch, or someone in the family might have passed away, had a portfolio of real estate. The rest of the family just wants to take the cash and run. They want to move quickly on it. That's where the kind of lending that we do, private lending, and speed and ease really is the win. So if that person's looking to sell that property for X amount of money, our borrowers go in and say, I'll give you 15 or 20% less, but I'll close in 72 hours or 96 hours. So the person selling says, you know what, I'm willing to take that discount knowing how quickly this person can close. So we believe with our access to off-market deals, our ability to close quickly and use cash, our ability to then understand the use of leverage, take a long-term approach to it, have economies of scale on costs because we can do that because we're a nice size organization. We have accounting teams, we have managers, we have property managers, we have people who do rehabs and updates and renovations and repairs. We know all the players. We don't have to hire them from scratch. We already know them. We have discounted deals with them already. We have access to deals that the regular people sort of day to day can't get and won't get. And we don't have to hire and build out a new team because we have all the teams in place ready to manage the fund. We keep the costs and expenses extremely low. We can move quickly and act quickly on deals as they come up using the network we have and the access to cash we have. We understand how the financing works better than anyone, I would argue, because that's what we've done for all these years. I've been in the mortgage business for 25 years. I understand financing leverage and how to make the dollars and cents work. So we believe with all that expertise, we can provide value and provide a really great return on the rental property market in the greater mid-Atlantic region. And so we're really optimistic on that.
And one, if I
Yeah,
add one quick, sorry, Josh, it also comes quite simply down to supply and demand, right? Economic market fundamentals remain in place and supply continues to fall behind demand, and moreover, I think it's really easy to get lost in the greater stories since COVID, where you did have kind of a run up in appreciation. But if you actually look at the data from the past 12 to 24 months, rental, or not rental, well, both rental and house prices had actually stabilized. So we might have been seeing other conditions in other markets, for example, the S&P and other things, and they continue to have these crazy kind of year over year appreciation. They actually stabilized, the real estate market stabilized over the past couple of years. You had lower transaction volume. Meanwhile, and a broad national term, again, so we're speaking generically, you actually have seen incomes rise in a meaningful manner. They are slowly catching up. And so while I know there's kind of this greater story of, cost and all of that, and I'm not saying that's not true, you actually, I would say real estate has broken apart. It has stabilized, gone down slightly in some areas, and affordability is sort of back on its way. And again, actually, we could dig deeper into it. I think this bodes really well for rentals, but I will leave it at that. We are always looking at this and we're always studying it. So.
yep, yep, great stuff. And again, any and all of these questions and answers and information, happy to have much deeper conversations on a one-off with me, Jessica, all of us. So please feel free to reach out after this as well. Question about our interest rates and how they work and the minimum credit score. So this is more from the borrower perspective. So I'll briefly touch on this. Bio, thanks for the question. But this is probably something we would take offline and talk about you as a borrower. I'd love to help work with you as well. Our interest rates are high. That is how the private lending market works. We lend money out at generally 13%, short-term quick access to money, and we pay our investors, as you saw, 8, 9, and 10% plus, give or take, depending on some of the tax benefits. So that's the spread of how our business model works. So traditional bank, you would go to traditional bank in the current market, you're probably looking at 7 or 8%. So we're a bit more expensive, but for that expensive price increase, you're getting the speed, ease, and that's really where the value is. So we're right in the market for what this kind of market offers for the type of lending that we do. He also asked about credit scores. We don't have a minimum credit score requirement. Having said that, our average credit score is above 700 for our borrowers, but we'll take into account different compensating factors. I've had people with very bad credit scores, not very often, but we have done those deals. That would be a much lower loan to value. We would ask for more skin in the game. We would do a much more conservative deal. We'd still want to make sure they have the ability to make payments, or we'd ask for payments up front. So we can readjust based on our own decision to make sure that we and our investors are always safe. And so that's the ability that we have as our own business, not a bank, not having to go to a loan committee. We can make our own decisions in a very common sense and very safe approach. Okay, Jess, you want to get into the
Yeah.
answer on the actual returns and the IRRs? Yeah.
So the question is, are the loan to values about 65%? You state after repair value or current market value. So the quick and short answer is it depends, but on the majority, it's the after repair value. So if you had, I'm just using very generic number, if you issued a loan of for $65,000, that is typically with an after repair value of 100K, and that would be both purchase price and rehab would comprise that 65K. We didn't mention it earlier, but talking about how and what we issue loans to borrowers, every borrower is required to have a down payment. So of that 65K, they would have provided a down payment, and then we would be providing rehab and the remaining part of the purchase price. Once in a long time, or sometimes you will actually see that we use current market value. And typically in that scenario, the borrower is not requesting rehab. They might be trying to season a property because they're putting a renter in there and they're going to try to do like some debt service coverage ratio, some nuanced stuff. They're typically more sophisticated borrowers. But on the whole, on average, it's after repair value. For direct notes, is there a loan servicer and are the payments sent direct from the borrower? So we are the loan servicer. We will live what we issue, and I think that's really important. Which is why we're going to keep those quality loans. And the borrower sends us the payments each month, and they pay off the total value of their loan.
We have a really great team who is communicating with people and tracking people down if needed. But I will say we have, knock on wood, a really great payment history with all of our borrowers. They're electronic payments, so it happens on a regular basis. It pulls the payments from electronically from everyone's bank accounts on the first, second, and third of every month, and then those payments are then transferred and paid out to you, the investor who has given us the money to fund that loan. So we've got a really good track record with that, and that's the benefit, as one of the earlier slides said, is controlling the whole process. We control the whole process from A to Z, from cradle to grave, right, all the way through. So someone coming to us to borrow money, getting access to rehab funds, getting underwritten, getting checked out, all the due diligence we do, making sure they make payments on time. We're very careful and diligent about giving out rehab money only after the work is done. That's a whole nother webinar we could do. Working with them on either refinancing out of that loan or they pay it off upon sale. And ideally repeating the process again as people try to build that portfolio. We handle everything from A to Z: operations team, sales team, servicing team, closing team, post-closing team. And then on the investor side, for the people who are funding those loans, an investment team, investor relations, which Jessica oversees, which is working with everyone who would be looking to invest and put their money to work into these loans. So we control the whole sort of space itself. And we like that. We're not buying notes that we don't know about. We're not doing things that we don't have control over. We control the entire process, A to Z. And that is really key to, we believe, the safest and best possible investment. With regards to returns for the real estate fund, someone asked a question about the actual returns. Would we be able to see the actual returns for the real estate fund and how the IRR is going to work? So yeah, so our hope is, our plan is to be able to provide those regular returns for the real estate fund on a quarterly basis. Everyone can see what the returns are. Everyone is a member of this fund. Everyone is an owner, a partner, a K1 member of the entity. As such, full due diligence and full transparency on seeing what we own, what we're buying, what the returns are. That's going to be paramount to the success, and the communication with all of our investors to see what the returns are and to understand what the costs are. That's how the payouts work. That's how all the dollars and cents are going to work with that fund. So we'll provide full transparency on that. And then on the whole fund itself is where we believe that larger internal rate of return will realize into a double-digit return. Obviously, there's a lot of factors that kick in: time frame, leverage, how much money we've raised, how many properties, how long we're holding it for, a whole variety of things, the interest rate environment, et cetera. But on the whole, we have a 100% confidence that we will be successful in this. We will make money in this. We will have a significantly double-digit return on this as well. And that, as I said, we know that over time, real estate's going to pay off. And we're just a huge believer in the broader mid-Atlantic market for the rental properties as well. Another question on Baltimore City. So we do finance in Baltimore City. I would say it's very selective. We're very picky in Baltimore City. We love Baltimore City, but we're also picky and selective in Baltimore City. You have to know the market. I would say we know the market as well or better than anyone else out there. We've been in Baltimore City for many, many years, so we really understand each block, each house, one by one, street by street. Having said that, part of our growth model is continue to expand outside of Baltimore City. We're doing more and more throughout the state, more and more throughout the greater Mid-Atlantic, and as we said before, heading down the East Coast as well. Jess, you want to take the next one?
How soon do borrowers start payments on a loan for a fix and flip? I'm gonna give like the non-academic answer. Josh probably has like a pretty way
Yeah.
of saying it. So it's the first full month after you've closed. Like I don't know how else to say that, but
Well, I think the question, yeah, no, that Jess is right. Obviously, it's immediate. So, but the question comes
yeah,
from, I assume, Katrina, thanks for the question. I assume it comes
yeah.
from there are some of our competitors out there in the broader marketplace will allow a pause or a wait on payments. So some people will say, "Oh, you don't make payments for the first 6 months. You don't make payments for the first
Mm,
3 months." Some people don't collect payments at all, and they just add it on at the end. We do not believe or subscribe to that at all. It has lost us some business, okay? And I have no problem with that, and we have no problem with that. We only work with people who can make the payments on a regular basis. If you cannot make the payments and you're banking on the property selling for the right amount and hoping that it's going to work out down the road, and if it doesn't work out, the payments may not work. We just believe that's a high risk approach. And again, we're very conservative, and we believe this is a major benefit to you as a potential investor. We want to make sure that person has the ability to make the payments immediately after closing. Their payments start up, and the first of every month their payments are due. That is really important to have skin in the game. I've been in the mortgage business a long time. During the meltdown in 2007, the people who sent back the keys, you may have heard of those kinds of stories. People literally would put their keys in an envelope and send it back to the mortgage company, are people who didn't know where to go, what to do. But there were also people in the investor community who didn't have skin in the game. So they were offered 100% financing deals, no payments, interest would accrue over time because the values were only going up. I can't lose. And so those are the people who are most inclined and the quickest to turn their keys in and walk away from the property. Now, why did they walk away from the property? Because they weren't going to lose anything by doing that. If you don't have skin in the game, you don't stay in the game. We believe, and this is again one of the most important lessons Steve Bond has taught me from day one in this business. You need to have skin in the game. You have to have money, a down payment that you put in, a closing cost expense. If you put in 20, 30, 40, 50, 70, 80, $100,000 into that property, you're not walking away from it. We are partners together. I'm saying this as to the borrowers that we lend money to. And we say this on the phone to people. We're in this together. You're asking us to give you $250,000. I'm only asking you to give me maybe $50,000 or $75,000. I'm going to give you all the rest, but we're in this together. You've got to bring some money to the table too. So I know you're committed to this deal. That keeps our defaults low, and that helps
mhm.
protect our investors. And that's really important to our success over the long term. Another question over on the webinar chat. For direct note, are you funding an individual loan or portfolio of loans? On the direct note investing, it's individual loans. On the fund investing, it's the entire portfolio of loans. So there's sort of a risk diversification, right? So you're only on one specific loan on the note investing, but on the fund investing, it's spread out over literally hundreds of loans. And that's, we believe, a real benefit as well. Minimum and maximum investment levels. Great question. As I think I
Mhm.
mentioned before, our minimum investment is $100,000. Okay. Our minimum loan amounts are $150,000. So we won't lend to a borrower a loan under $150,000. Okay. There's other lenders that do that. We just like to make sure the value is a little higher so it makes sense for loan amounts at 150,000 or above. For investors putting money into fund loans, everyone on this Zoom webinar here, $100,000 is the minimum. That means you wouldn't necessarily be funding an entire loan, but we might be funding the rest of it. Another investor might be funding the rest of it if it's individual note investing, or you would be investing in the pool, which means it's spread around the risk on all those loans. As far as a maximum investment level, we'll take all the money you have. So I mean, there's no
And
cap, right? There's no cap. So on the lending side that we lend out to people, our cap is about $3 million is sort of our comfort level. We do have one loan at $5 million. That's a little bit of an anomaly for us. So our minimum is 150. Our cap is about $3.5 million. For the investors, the minimum is 100,000, and there is no cap. We have people, individuals who have $6 million with us. That's a large and significant amount of money. And we take that, and as we take all of our money and care for it as if it's our own in a very serious way, with a significant and serious burden of taking care of people's money and looking after their personal finances. But there's no limit on that. I would encourage diversification, which is sort of the lesson we would say to anyone, right? Most of our investors we see, this is an unofficial sort of statistic here. Most of our investors have a decent amount of sort of stocks and bonds that they do within the broader market, a decent amount of their own real estate. That means their own home, maybe an investment property themselves, or maybe a vacation home as well, and then investing with us as well. So it's about a third, a third, a third. And we believe that's really a safe approach for a lot of our investors for how they look at investing with us. Some people have done much more with us, some people have done much less with us. That's a personal decision. We're here to support any and all of those decisions. Some people take the monthly payment and live off of that monthly payment. Some people, as Jess said before, reinvest that monthly payment and grow that portfolio over time. And that's going to be a really great way. They'll be doubling their money in a very short amount of time with those returns and with that reinvestment of the monthly dividends. That's a great way to grow one's portfolio as well. Other questions we can answer? I think we've covered a pretty good amount. We're up to an hour now.
Yeah.
All right. No problem
Yeah,
at all. Okay.
I think we did.
I think we've got everything. I'll
Yeah.
end with thanking you for your time. As Jess said early on,
Mhm.
time is valuable, and it's one of those valuable commodities out there. So thanks for spending the time with us. Thanks for spending the hour with us during your lunch hour today. We really appreciate the time. We'll be following up with you with an email with some of our contact information, Jessica's contact information. As I mentioned over and over again, there's no bad question, there's no stupid question, there's no wrong question. Please, please, please reach out to us for anything at all, big, small, or medium. We could review every aspect of what we talked about today. What's most important for us is that every investor that works with us does not put in a penny until they've understood A to Z how it all works, the ups, the downs, the left, the right, the good, and the bad. It's really important. We're not a pressure sales organization. We're not a pushy organization, both for our borrowers or our investors. We're all about great communication, great relationship. That's what it's all about. And we're happy to answer any questions and spend as much time with people as needed and as necessary, over as many meetings as needed as necessary, to make sure you feel comfortable with investing with us and understanding what you're getting into. So thanks again for
And
your time. We hope to see you soon. Jess?
that's my cell phone number. So that 202, you can reach me directly, and that email goes straight to me as well. Yeah.
Thanks for your time. We look forward to
Thank you.
hearing from you. Please reach out with anything and have a wonderful rest of the day. Thank
Thank
you.
you. Take care. Bye.
Bye bye.